Hello. In this recording of our Justia webinar, 5 Steps to Tax Mastery for Law Firm Owners to Enhance Profitability, Darren Wurz helps legal professionals understand the intricacies of tax law and how to leverage it to their advantage. He also shares practical techniques and actionable insights designed to minimize tax liabilities while maximizing returns. Remember, if you'd like to see more Justia videos on law practice and legal marketing, be sure to subscribe to our channel.
All right, Nina, thank you so much for that great introduction. I'm excited to talk with all of you today. Thank you so much for joining me on our webinar. What a great topic today, tax mastery. You know, as we come into the end of the year, a lot of great things to think about as you wrap up the year and think about how you can minimize your tax liability for 2024. And many of you may be just finally signing your tax returns for 2023. So we want to help you get out of that cycle and hopefully not have to file those extensions. And I'll share some ideas around that later. All right, today we're talking about tax mastery for law firm owners. And really, this is about profit maximization because, you know, let's be honest, taxes are likely one of your largest line item expenses. So we want to help you get some ideas around reducing taxes for your law firm, reducing taxes for you personally, and thinking long-term about reducing taxes over your lifetime. So that's where we're going today. All right, just a little quick blurb about me. Nina already did a great job. Some resources that we have available. First of all, I'm the founder of a financial planning firm called Wirtz Financial Services. We also go by the name The Lawyer Millionaire. We do a lot of the same things that most financial advisors do, but we are a little bit unique in that we exclusively work with law firm owners. And so we've built a process that includes a lot of the traditional financial advising things, you know, investments and stuff like that. But we go a little bit beyond that. We wanted to provide a holistic service that really speaks to law firm owners. So we help with tax planning, cash flow management, insurance planning, and also on top of all that good stuff, business planning. Because at the end of the day, growing your business is probably your number one priority and most likely your easiest pathway to wealth. And we understand that. And so we want to help you make the most of your opportunities as a business owner. We have the podcast, The Lawyer Millionaire. You can check that out wherever you get your podcasts, Apple Podcasts, Spotify. It's out there. A lot of great stuff. We interview successful law firm owners and then also talk about all things business and finance for law firms. And also we have the book that's available at the ABA bookstore as well. Okay, I'd like to learn a little bit about you. So real quickly here, using the Menti, why don't you share with me what your practice area is? So popping up on your phone or mobile device should be a little field for you to type in what practice area you are in. So you can just go ahead and type that in. And as soon as you type it in, it's going to come up on the screen here. All right, we've got some folks who have figured it out. Family law is coming up. And fam law, I don't know if that's different. Maybe they're the same. Personal injury, real estate, child welfare, employment litigation. Great. We'll wait for a few more responses. Go ahead and type in your area of practice. And as you'll see here, we're forming a word cloud so we can get an idea of who is all on the call today. And it looks like personal injury and family law are really the most represented. And then we have some others as well. All right. Fantastic. Well, thank you all for being on the call. This is great. Med mal, immigration, and some others. Good stuff. Well, keep participating because I've got one more question for you here. And that is, how many attorneys are in your firm? Just to get a sense of the size and of the firms that are represented here. You've got a few options: solo, 2 to 5, 6 to 10, 11 to 25, or 26 plus. I'll give you a few seconds to answer that question as well. And as expected, looks like we have a lot of solos, some smaller firms, 2 to 5 attorneys, and at least one larger firm. So great. We've got some great stuff for all of you. So even if you're in a big firm or if you're running the business yourself, I've got some great ideas for you around tax planning. I'm not surprised by this. I think 50% of attorneys do practice either as solos or in small practices. So this is quite expected. All right, let's talk about tax mastery for law firm owners. Minimizing your business's taxes, number one, we'll talk about that. Then we'll transition into managing your personal taxes, and I'll give you some ideas for how you could reduce those personal taxes. And then finally, we'll wrap up by talking about a tax-free future. Yes, tax-free future. And give me just a moment here, and I'm going to open up my control panel so I can navigate this with you here. All right. Sorry, folks. I'm just going to come back here and then go back to the present mode. Okay, let's dive in. So first off, minimizing your business's taxes. Let's talk about that. First, I want to clarify a concept. When we talk about tax planning, I want to be crystal clear about what tax planning is and what tax planning isn't. You know, I talk with a lot of people and they're like, oh yeah, tax planning. I already do that. I have a CPA. Well, not necessarily. You know, the sad fact is most of the people I talk with, the relationship they have with their CPA, they might talk a little bit about taxes throughout the year, but at the end of the year, they get their tax return and their CPA is emailing them in October saying, here, sign this and send this in. And there's not a lot of proactive thinking ahead of time about strategic ways we can position our business to reduce taxes. Tax planning is something that happens all year long, not just in tax season, but something that happens ahead of time. And it's something where we're thinking long-term about the future. Now, a lot of CPAs do offer tax planning services, but they don't advertise them very well. So if you're not getting tax planning services, you may want to ask your CPA if that's something that they offer. The goal with tax planning is not always to pay the least amount of taxes every year. In fact, there may be some years where you want to actually pay more in taxes. What? Hang on, because I'll show you how and why that works coming up. But basically, the main idea is to always pay the income tax at the lowest effective rate. And it's not about the tax bracket. So I really want to hammer this, right? So you have a series of tax brackets, and people often think if they cross over the line, right, from the 22% bracket to the 25% bracket, that all of a sudden all of their tax is increased. Well, the tax system is a progressive tax system. So the lower amounts of income, you know, the amount of income, the first 10,000 or so gets taxed at a 10% rate. And then the next amount gets taxed at a 22% rate. So your bracket only really tells you what the last highest amount, the last portion of income is being taxed at. What we want to assess is what is the overall tax rate? And that's called your effective tax rate. When we look at all of your income and the total amount of tax that you're paying, what is that effective tax rate? So it's not all about the bracket. Okay, so here's a little statistic for you. According to Forbes, 93% of small business owners are paying more in taxes than they need to. And I would imagine that statistic probably holds true similarly for many law firm owners as well. The reason I think that is because I know, at least in my many years of experience working with law firm owners, I know that you guys are very, very busy. And so you don't necessarily have the time to be paying attention to these things. So it's probably true for a lot of law firms as well. And here's a staggering number for you, $60,000. This is the amount of money I was able to save one client through effective tax planning. It's very true. Just taking a look at his tax return and before he filed it and thinking strategically about what we could do differently. Okay, so when it comes to managing your taxes for your business, one of the easiest places to start is with your retirement plans. There are a variety of different retirement plans available to you. You have a simple IRA, SEP IRA, 401k, and one that's not quite as common is the defined benefit plan, or sometimes known as a cash balance plan. So we'll talk about what these are here in a little bit more detail. All right, so when it comes to retirement plans, the basic concept is the concept of tax deferral. You're not getting out of the taxes, you're just paying the taxes later. So when you put money into a retirement plan, those contributions get to be not counted as income, right? I put $10,000 in my 401k, I get to reduce my income by $10,000. Basically, I am delaying taxes on that money till later. But here's the problem, potentially. The tax liability is only deferred. So it's only going to help me this year. It's going to create a tax liability for the future. And so that's generally on the pre-tax side, how these retirement accounts work is that you pay income tax on your withdrawals in the future. Most people understand that, but I just want to be real clear about that. Okay. Now, here is a quick breakdown of these different types of retirement plans. Now, many people are very familiar with the SEP IRA. The SEP IRA is a very easy, simple way to go. It is often a favorite among CPAs and accountants because of its simplicity. And the way the SEP IRA works, it's simply an account that you set up. It doesn't cost anything to set it up. There are no employee contributions. All the contributions are from the employer. So this is really popular with sole proprietors, with solos, when you don't have any employees because it's just you. It's very simple. And the way it works is that everybody gets a percentage of salary. Everybody gets the same percentage of salary, right? And the cap on that is either 25% of your compensation or $69,000, whichever is less. These are 2024's numbers, okay? So really, really popular for, if you're a solo, all by yourself, very simple, easy to set up. You just open the account, put money in it. Boom, bada bing, okay? Where it gets complicated is if you have employees, okay? Because here's what happens. Whatever percentage you're giving yourself, you've got to give the same percentage to everybody, right? So then it becomes a little bit more strenuous, right? If you're giving yourself a 20% contribution, 20% of your salary you're putting into your SEP, you got to do the same thing for each of your employees. 20% of their wages, you've got to put into a SEP for them. So at that point, that's typically when people will move either to a simple IRA or to a 401k. Now, the simple IRA and the 401k are very similar. The main difference is that a simple IRA follows kind of a preset formula. So the simple IRA is easy. One reason people prefer it, it doesn't cost anything to set it up or maintain it. And here are your amounts. So employees can contribute a percentage of their salary. The maximum is $16,000 or $19,500 if you're over the age of 50. Meanwhile, on the employer side, the employer must contribute. You got two options. Either you give 2% to everybody, or you give everyone a match up to 3% of their salary. So you have a couple of options there. Now, why would you want to do one or the other? Well, 2% means that, if people are likely to participate, maybe you want to go the 2% route. It's going to save you. People are less likely to participate. Maybe you want to go the 3% route. You're going to incentivize them to participate by offering that match. And then those that aren't contributing, you won't have to put anything in for them. Then we move over to the 401k. The 401k is very similar. Employees contribute a certain percentage, and then employers contribute a certain amount. But the key difference here with the 401k is that it is very customizable. There are safe harbor formulas. Basically, The IRS has preset formulas that you can follow that reduce your risk of being audited and running afoul of the IRS's non-discrimination rules. And this is why 401ks cost a little bit more, because you have to usually have, well, it would be smart to have a third-party administrator administering the plan, making sure that the plan is in compliance with the IRS, making sure that all the proper forms are being filed with the IRS as well. So there's a little bit more regulatory work when it comes to a 401k. But the 401k is super powerful. Employees can contribute up to $23,000 or $30,500 if they're over 50. And the other really cool, powerful thing is that not only can contributions be pre-tax, but they can also be Roth. And we'll get into the differences, but pre-tax amount is what we've been talking about. A Roth contribution is one where you do not get the tax benefit up front, so you don't get a tax deduction for putting the money in, but the money is permanently, well, it's tax-free if you leave it there until retirement age when you take your withdrawals, okay? And then on the employer side, the employer can provide a matching contribution or non-elective contribution. You have a lot of flexibility there. And the overall maximum between employer and employee is either $69,000 per participant or $76,500 if you're over 50. The other really powerful thing about 401ks is you can set eligibility and vesting requirements. So it can be an incentive to maintain, for employee retention, to try to keep people at the firm. It can be very helpful that way. Now, there's one other version of a 401k that we need to address also, and that's the solo 401k. So if you are a solo attorney, you don't have to just do the SEP IRA. You could do a 401k just for yourself. It's called a solo or an owner-only 401k. And the powerful thing about that is look at the amounts, right? It does cost a little bit. It's not this expensive, right? Typically what I've seen is a solo 401k is about $300 to $400 a year to set up and maintain, but you can put a lot more into it, right? So you get that catch up. If you're over 50, your amount goes up to $76,500. There's no 25% limit on the employer portion, which is really powerful. And you have the ability to do Roth contributions, which is a great advantage. All right, we're almost done, so hang with me here. The last one is kind of, I don't know, my favorite, probably not my favorite, but it's really, really cool. It's the cash balance plan. Not many people know about a cash balance plan. It's also called a defined benefit. So in the IRS code, you have two types of retirement plans, qualified retirement plans. You have defined contribution plans. Those are these. Defined contribution means that there is a certain amount of contribution being made. And then you have defined benefit plans. Defined benefit plans are technically what we would call pension plans. They're separate. And so because they're separate, you can have both. You can have a 401k and a cash balance plan. So what's the cash balance plan all about? Well, a cash balance plan is a type of pension plan that allows you to defer much larger amounts of income, because the formula for how much you put into the plan is based on the age and the compensation of the participants. So typically cash balance plans cost a little bit more to set up and run, but look at this number, $275,000. You can put a lot more money into these types of plans. Now, I'll be honest, these plans are more tricky to set up. They require a lot more paperwork, and they have to be funded a certain amount for a long period of time, right? And to maintain eligibility with the IRS. But these can be really, really powerful. If you have a law firm that is generating, I have clients that are making $1 million plus, and for consistently each year. And for those clients, this plan becomes super, super powerful for them, because they can take a bunch of money out of their current tax situation and defer it until later, when they will likely be in a lower tax bracket. Okay, and by the way, I'd be happy to entertain any questions as we go along too. If you have a quick question you want to pop in, we can do those, or we can wait it till the end as well. So I know I just went over a lot of information here, and I'd be happy to send this to anyone that would like a copy of this quick cheat sheet on different employer plans. Just send me an email. I'll show you my email address later on, and I can send you a copy of this. Okay, but let's keep it moving. Another easy way, quick win for reducing your tax liability is through the way that your business is organized, okay? So typically, the way most folks are paid, W-2 employees that work in large businesses, the business and the employee split the Social Security and Medicare tax. So Social Security is 6.2%, Medicare tax is 1.45%. When you're a sole proprietor, though, when you're an LLC, a flow-through entity, right, or a sole proprietor, you pay both halves, which means that you pay 15.3%. That's a lot, right? And so that can add up very, very quickly. And I'm going to show you a strategy for how we might reduce that amount. Now, there is a question coming through. It says, how are IRAs you are discussing different from a Roth or traditional? Great question. I'm just going to hop back over to this previous slide real quick. So all of these are employer plans. The Roth IRA and the traditional IRA are individual, okay? So you can totally have an individual IRA, Roth IRA, and you can max those out in addition to these as well. Great question. All right, let's move along here. So we're talking about business organization. How can we reduce this 15.3%, okay? And I'm going to show you how we do that. Okay, this is what we call the S-Corp strategy. So if you're an LLC or a flow-through entity, first you have to be an LLC first. If you're a sole proprietor, you're going to want to file as an LLC or establish an LLC first. And then what you can do is you can elect to be taxed as an S corporation. What that's going to allow you to do is split your compensation into two parts. One part salary and the other part distributions. And the beautiful thing about this is that you will only have to pay self-employment tax on the salary portion and not the distribution portion. Okay, so let's take a look at how this works. Okay, I have two scenarios here for you, right? First scenario is a sole proprietor or an LLC. And let's say your total revenue is $200,000. Your business expenses are $100,000. So you are netting $100,000 in income. As a result, at that 15.3% self-employment tax, you're going to pay $15,300 in self-employment taxes, okay? Conversely, if you elect to be taxed as an S-Corp, same revenue, same expenses, but what you're going to do instead is you are going to pay yourself a salary of $60,000. You're going to run payroll and you're going to pay yourself $60,000 as an employee of your business. And then as a result, you're going to have some payroll taxes, okay? Then your net income is going to be $34,000. And your portion of the payroll tax is only going to be $5,353. So then the total payroll taxes paid is only $10,000. Look at that. A savings of almost $5,000. Now, I don't know about you, but I would love to have an extra $5,000 in my pocket. And this is because you only paid the self-employment tax, the Medicare and Social Security taxes on this $60,000. And you didn't have to pay it on this additional income here. So that it's split. This is the employee's portion, and this is the employer's portion, and there you go. Okay, pretty cool stuff. Now, this doesn't work in all states necessarily. Some states, well, it works everywhere, but some areas do have an extra little sneaky S corporation tax. The state of New York has an S corporation tax, but it's very, very minimal. But where you really get nailed is if you're in New York City. If your S corporation is in New York City, there's an extra 8% S corporation tax that basically kind of eliminates any benefit here, right? So If you're in New York City, then this may not be the best solution for you. Also, if your income is really, really high, you phase out of Social Security tax at a certain point. Medicare tax you keep paying, and in fact, you have to pay more at certain levels. But it may not be quite as advantageous at much higher income levels. And we have a couple other questions coming through. How do you balance contributions to Social Security to increase retirement income versus minimizing it and using the savings to put into 401k? Okay, this is a good question. One potential downside here is that you are paying less in Social Security tax. So as a result, your Social Security record is going to be lower. So your Social Security income in the future may be lower as well. Now, Social Security, the way it's designed to replace a higher portion of the lower. It's kind of the formula takes your income and divides it into brackets, and is designed to replace more of the lower amount of your income, right? For lower income people, basically. And as your income goes higher, Social Security replaces less and less and less and less. So there is a balance here, right? Where there is a point at which paying more Social Security income tax really doesn't give you much more benefit, and so this type of a strategy would really be advantageous. And someone like me can help you kind of run those numbers and figure out what that number should be. I also want to mention that you might be thinking to yourself, well, why not just classify all of my income as a draw? Well, sure, but the IRS is probably not going to like that. So you have to pay yourself a reasonable salary. You can't pay yourself a salary of $1, right? That's not going to fly. Okay. Another question here: does Michigan have an S corp tax? I'm not exactly sure on that one. We may want to Google that and find out. Okay. So let's talk about some other potential ideas and try to get creative. So here's some creative ideas for you to reduce your business taxes. Number one, you could employ your children. The reason this is kind of a great idea is, number one, whatever you pay your kids is a tax deduction to the business and tax-free to them up to the standard deduction amount. Now this, I don't know if this is out of date or current, but they have their own standard deduction, right? And so whatever you pay them up to the standard deduction is going to be tax-free to them. Wow, tax deductible to you, tax-free to them. They must be doing legitimate work. But here's a really cool thing. What if you took that and then you put that in a Roth IRA? So what if we pay them $14,000? It's tax-free to them. It's tax deductible to the business. And then it goes in a tax-free account. Yeah, that's a great idea. Or make them pay for their own activities. And then all of a sudden, your kids' activities have become tax deductible. Here's another idea. You could hire your spouse. Now, some of you may cringe at this idea. But this could be a powerful way to maximize the amount of money that's going into your retirement plan and maybe give your spouse some Social Security credits. So you're going to put your spouse on payroll. The downside is that there are some additional payroll taxes, but the big upside is that you open up, basically you can double your retirement plan contributions, which could be really powerful. Take a vacation, right? How many of you travel for work? If you do some business travel, you could pair business travel with a vacation, and then a portion of those expenses becomes tax deductible. The catch is that the trip must have a primary business purpose, and you have to spend more days doing business than non-business, right? But your family can be hanging out at the beach, having fun while you're at the conference, right? So this is one idea. You could potentially pair a business conference or some kind of business endeavor with a vacation and make that part of that vacation tax deductible. Another question coming through: are children age 18 or less? On that last slide about hiring your kids, it doesn't matter what age the kids are. They could be any age. Now, it might be hard to tell the IRS that you're paying your 4-year-old to run your marketing strategy, right? So you got to be a little bit smart about that. Whatever you do has to be justifiable. But there's not necessarily any age limits on hiring your kids. And lastly, we need to talk about end of year tax mastery. And this is critical as we are coming to the end of the year here, right? So think about this, right? You need to, first of all, know how your year is playing out. If you've had a great year this year, you are going to want to accelerate expenses. So prepay some things for next year. That's going to lower your taxes. And maybe try to defer some income into next year. So maybe you delay billing some people until next year, or push some of those bills out, those receivables out into next year. They play with the end of the year that way, and you can try to mitigate your tax situation. So if this year was above average in terms of your income, maybe you want to do that. If this was a terrible year for you in terms of business, you can do the opposite, right? Try to bill some clients up front, get their income into this year, right? Offer some people maybe a discount if they pay up front, get the bill in before the end of the year, or push some expenses out into next year. So some things to think about as we come in to the end of the year. Contingency fee deferral, I do want to mention this. So if you are an attorney who's paid on any kind of contingency fee, could be personal injury or any kind of contingency fee, you have the opportunity to structure your fees and defer those fees over a period of time. This can be really powerful because it can help avoid pushing you into a high tax bracket, right? If you get a large settlement in one particular year, that's going to push you into higher brackets. And as a result, you phase out of all kinds of tax benefits and tax opportunities. And so that can really drive up your effective tax rate. So one of the companies we really like for setting up structured fee arrangements is Structures Incorporated. And there's a link here in the presentation. You can click that link. And they've got a lot of great educational materials on their website about how this works as well. But here's just a simple breakdown, right? Let's say you're married filing jointly in California, and you have a $1 million settlement fee, and you get it all this year. Well, your tax is going to be $493,000 on just that, right? And you're going to net $507,000. On the other hand, if you defer that fee over 5 years, take $200,000 a year, potentially your tax could be $62,000 a year, total being only $313,000, and then you end up netting a whole lot more. So this, obviously a lot is going to depend on your own individual tax circumstances, but spreading that income out over a longer period of time, trying to keep yourself in a lower tax bracket can really make a huge difference. I mean, that's a $180,000 difference. I mean, I would like another $180,000. Sure, why not? All right. I have a free giveaway for you. So if you would like, I mentioned the book at the beginning of the show here. There's a whole section in the book on taxes. So if you want, I'll send you the PDF of just the taxes section for free. So popping up on your screen now should be a little area for you to type in your email address and phone number, or not phone number, email address and name. And if you want to just type in your email real quickly and your name and hit the submit button, and this is on the Menti. I'll be happy to send you the tax planning section of my book, as well as that retirement plan breakdown that we showed earlier. And if for some reason you still need to join the Menti, you can just use the instructions are at the top there. Go to menti.com and type in that code or scan the QR code. I'll give you a couple seconds to do that if you'd like. On the other hand, if it's easier, you can always just email me. So that's a dpw@wirtzfinancialservices.com. So, and if you missed that, that'll be available to you later as well. Okay, so let's move on to our next section, managing your personal taxes. I've got some ideas for you there as well. Number one, you have your retirement accounts, right? So we mentioned earlier, these are separate from the employer retirement plan. So you can max out these in addition. So your traditional IRA, This is a pre-tax account. Money you put here is tax deferred until later. Roth IRA, you do not get a tax deduction up front, but in retirement, age 59 and a half or older, any withdrawals are tax free. And one last one that we really need to mention is the health savings account. That can be a really powerful way to get some additional tax deductions. Now, here's something I see all the time with clients. I see people putting money in their health savings account and then spending it every year. I think that's a mistake, generally. Now, it might be smart for you, but usually the best practice is to put money in the health savings account and not spend it. And here's why. When you put the money in there, it's tax deductible to you. It grows tax deferred, and you can use it later. So it's to pay for medical expenses, tax free, right? So you want to let that money grow because that money can be a tax free source of funds for healthcare expenses later on down the road. So that's really, really critical. The other thing is health savings accounts do not have RMDs, unlike traditional IRAs. So that's a really big benefit there as well. Okay, here's a little breakdown. Traditional IRA, tax deductible, Roth is not. There are penalties on withdrawals before 59 and a half. There are some exceptions to withdrawals, but the big thing here is the retirement withdrawals. The traditional IRA retirement withdrawals are subject to income tax. So everything, the amount you put in plus any earnings, right? The whole thing is subject to income tax. Whereas with the Roth IRA, the whole thing is tax-free. The amount you put in plus the earnings. And then, of course, RMDs. So traditional IRAs, the government forces you to start taking money out of those accounts at age 73, and that amount goes up higher and higher each year because they want to tax the money that's there. Our Roth IRAs do not have those RMDs. And another thing we need to think about is as it relates to inheritances. With traditional IRAs, beneficiaries pay tax. They can defer it over 10 years, but with Roth IRAs, beneficiaries pay no tax. Now, this can be a big problem for beneficiaries. If you have a large IRA, and if your kid inherits $1 million IRA, they're going to have a lot of tax to pay. And if they are grown and they've got the job of their own, that could really mess up their tax bracket for some time, right? So that's a critical thing to think about. The health savings account, we mentioned contributions are tax deductible, growth is tax deferred, withdrawals are tax free if used for qualified health expenses. These are then treated as IRAs after age 65. So you can pull the money out for any reason. You just have to pay income tax. But here's the kicker: no RMDs. That's a really big benefit to the HSA. All right, now I really want to talk about this, so buckle in. The Roth conversion. This is the golden tax planning opportunity. So if you get nothing else from this presentation, I really want you to cue in on this. Roth conversions can be a really, really savvy strategy for you, okay? A Roth conversion is basically where you convert pre-tax traditional IRA funds over to your Roth IRA. So what you're going to do is you're going to take a chunk of money out of your traditional IRA, pay the tax for the benefit of moving it over to your Roth. Why do you want to do that? Because when it's over in the Roth, then it's tax-free forever, right? Some things to know about this: the amount is there are no limits, there are no minimums, there are no maximums. It's unlimited, the amount you can convert. It can be as little or as much as you want, okay? And the big benefit is to achieve tax-free growth. And I'm gonna explain why this is a smart idea here. Okay. The other thing that we want to take advantage of potentially is a backdoor Roth IRA. For folks who make too much money, you phase out of your ability to contribute to the traditional IRA. If you make too much money, you can no longer contribute if you have an employer plan. So instead, what you can do is a backdoor Roth. And in this strategy, essentially, you are going to contribute funds to your traditional IRA as a non-deductible. So you're not going to take the tax deduction, and then you're going to immediately convert it over to your Roth. Now, if you're making $500,000 a year, you can no longer, and you have a 401k, you can no longer make IRA contributions, right? Doing this isn't going to give you any tax benefit in the current year, but you still want to do it. And here's why. Because it's going to be building for you a pool of tax-free money to use in the future. So it's a really smart idea for high earners, and it becomes one of your only options. There is a caveat here. A portion of the conversion amount might be taxable if you have existing pre-tax IRA funds. So you really want to work with somebody qualified to help you do this. All right, and one last slide here on getting creative. All right, so I mean, a lot of law firm owners make really great money, and they're already in the 37% bracket. And then it's like, okay, what the heck do I do? I'm maxing out my 401k. I'm maxing out my cash balance plan. I'm doing everything I can know how to do. What else can I do? Okay, well, here's some ideas for you. It might be smart to become a C corporation. So here's why you might want to do that. When you're a C corporation, you're no longer a flow-through entity, which means you can leave money in the business and not pay tax on it. All right, so the corporation pays its own. Now, the downside is that money made through a corporation is basically double tax, because the corporation pays a 21% tax rate, and then when you give the money to yourself as a dividend or as a draw, you're going to pay dividend tax rates. Okay, so there's double taxation. But here's the thing. If you're in a really, really high tax bracket, this might be good, because the corporation is only going to pay 21%, and then you can leave money in the business and not take it. You could take it later when you're in a lower tax bracket. So interesting idea. The donor advised fund could be a good friend of yours. If you are charitably minded, you have charities you like to support, a donor advised fund allows you to basically bunch your charitable contributions into certain years. So if you give $10,000 a year to charities, great. What you might want to do is give $100,000 to a donor advised fund. That would give you a $100,000 deduction this year. And then for the next 10 years, you can dole out money from your donor advised fund to your individual charities of your choice. But it's all about giving you the deduction in 1 year, because you don't get any benefit from charitable contributions unless it's more than your standard deduction, right? So it would be smart to bunch those deductions into 1 year, drive yourself into a lower bracket, and then, you know what? Here's the secret sauce. You might free up the opportunity to do some Roth conversions. Remember I mentioned that earlier? That's going to come back, so stay tuned for that. Charitable remainder trusts are another way to kind of do this. You put money into a trust, you get the deduction all at once, right? And then you basically live off of the interest later on. So there are some cool ideas you can do with that. Opportunity zones. Maybe you want to get a little bit more creative and look for investment opportunities in opportunity zones. Maybe you want to start a new business. I was talking with a client this week, right? And she makes, $900,000 a year. And it's like, okay, well, what can we do? Well, maybe, I was like, how about this? What if you buy a Starbucks franchise, or start a franchise, or start some kind of business? You're going to get a bunch of tax losses. You're going to get a bunch of, carry through losses and deductions to use this year and probably in the next couple of years. But you're going to be building a wealth generating asset for yourself long term. So maybe we need to invest in a business, There are also some creative credits that you can try to qualify for, R&D credits, energy tax credits, but those can be a little tricky. All right, year-round tax planning. So, tax planning is a year-round thing. We want to think year-round about it. Here are some things you should be looking for as you go throughout your year. We're in Q4. So this quarter, you should be looking at shifting, accelerating income and expenses. and thinking strategically about what can you do. Roth conversions. This is Roth conversion season right now. So what you need to be doing right now in Q4 is thinking, what's my income this year? And if my income is lower than normal, it's an ideal time to do a Roth conversion. I tell my clients, if you have a bad year, rejoice, because you've been given a golden opportunity to convert some of your pre-tax assets into tax-free assets through a Roth conversion, right? In Q1, you want to think about your retirement contributions, getting ready to file. Q2, you want to review that return. How many people review their tax return? Not many, right? So make sure you review it. Make sure there's no mistakes. I find all kinds of mistakes all the time. And a lot of times the mistakes are simply because the tax people and the investment people are not speaking to each other and not coordinating. Q3, you want to start thinking about end-of-year tax prep, RMDs, gain-loss harvesting, charitable giving, Roth conversions, adjusting your estimated tax payments. Did you know you can get penalized even if you meet your safe harbor estimated tax amount? You can still get penalized because it's all about timing. Timing is a big factor in making your estimated tax payments. If your income is much higher at the beginning of the year, your tax payments need to be higher at the beginning of the year. So you need to think very carefully about that as well. All right. I want to get into the tax-free future, right? And so this all relates back to what we were talking about with Roth conversions. So the dirty little secret about IRAs is that they are pre-tax accounts and they represent a growing tax liability. If you have $1 million in an IRA, in 30 years, that's going to be $16 million in an IRA, and it's all going to be taxable, right? And so not only, when you look at your IRA and you think, oh, I've got $1 million in my IRA, well, it's not all yours. 30% of it or so is the government's. They just haven't come for it yet. The other dirty little secret is that RMDs may represent a problem for you. If you have large amounts in IRA assets, when you get to RMD age, RMDs are going to start really low. But by the time you get to mid 80s, like you're 85 years old, you may be taking $200,000-$300,000 a year out of your IRA, and that may be pushing you way higher than you need to be in your tax bracket. And this affects everything because it's going to increase the amount you're paying in Social Security taxes. It's going to increase a lot of other taxes. It's going to reduce a lot of things that you're eligible for. It's going to increase your Medicare premiums. Yeah. So this is a really big thing that not a lot of people are thinking about. The key to avoiding this is to strategically start doing Roth conversions, right? Ahead of time. The best time to do Roth conversions is, for people who work a normal job and do the normal, like retire at 65 thing, right between when you retire and when you start Social Security age, right? So you can take advantage of some of those lower income years. But anytime you have a lower income year, should be a year to do Roth conversions. Another gotcha that the IRS has is the widow's penalty. And this all relates back to the IRS hidden tax bomb. Here's the deal. If one spouse dies, one spouse's Social Security income benefit goes away, right? So let's say we have person A and person B, and they're married. Person B dies. If they had the lower benefit, that benefit goes away. And so you only have one Social Security benefit now. But at the same time, the surviving spouse must start filing taxes as single. So here's what happens. Your income goes down. Your taxes may actually go up because the whole tax bracket changes. So one way you can avoid this is by having less money in traditional IRAs and more money in Roth IRAs, because if you have a source of tax-free income, then your spouse will be less affected by this problem. So here's my game plan for you for having a tax-free retirement. Build up your Roth and after-tax accounts while you're young. Contribute to your pre-tax accounts during your peak earning years. Make Roth conversions in low tax years. when you retire, live off of your after-tax money while simultaneously converting pre-tax money to Roth, and then enjoy a low-tax or tax-free retirement. Okay, we talked about a lot of stuff here and a lot of good stuff. So here's how to get in touch with me if you want to learn more about what we do. We've got some great resources on our website as well. Just head on over to thelawyermillionaire.com. And if you want to email me as well, there's my email address. It's dpw@wirtzfinancialservices.com. I know it is probably the longest email address in the world. But if you missed my email address earlier or you didn't catch the form earlier, just send me an email and ask for a copy of that, of the section of my book, and I'll be happy to send that to you. And I'll also send you that breakdown of the different retirement accounts. And then there's also the phone number, but the best way is probably email because I don't answer the phone. And hopefully you don't either, because hopefully as a business owner, you have grown and have somebody handling that for you. And I also want to offer anyone on the call a free 30 minutes with me. If you want to ask questions or you want to dive into your own specific situation, just head on over to tlmintro.com and free 30 minutes of my time. I'll also give you a free copy of my book if you'd like that as well. So the link is there, and you can click that link. That'll take you right there as well, and you can just book a time on my calendar right there. So we've got about 5 minutes. Happy to entertain any questions. Feel free to pop those in. Hi, Nina.
Hi, thanks, Darren. Before we move into audience questions, I just wanted to thank you for such a great presentation, highlighting the importance of and the strategies to effectively tax plan for law firm owners. And as Darren mentioned, we'll now open up the Q&A, so please feel free to send in any questions. And Darren, you can go a little over time as well, so feel free to take it if you'd like.
Okay, I see we have some great questions coming in. What qualifies as legitimate work for a child employee? That's a great question. Yes, it does need to be legitimate work. So it could be something as simple as coming in and doing some cleaning around your office. It could be helping you with advertising. Sometimes our kids are so much better at us with technology. Maybe there's some small administrative task that you could have them do, or maybe managing your social media, something like that. So get creative with it. Think about, things that they could be doing. The key is really just that you want to be able to justify it if you ever get audited, right? Now, you could you get away with not having them do work? Well, maybe, but it's high risk, right? So you want to make sure that you're following the IRS's rules and having them do legitimate work. Great question. All right, move on to the next one here. How does strategic entity structuring directly impact tax liabilities, and what factors should guide the decision for a law firm? So if you are a solo and you're in a state that does not, or in a jurisdiction that does not have one of those extra S corp taxes, then probably in most cases, filing as an S corp is going to be advantageous to you because you can, limit your salary and then limit the amount of your income that you're paying Social Security and Medicare tax on. So I think that's going to have the biggest impact tax liability wise. Like I said, there are some areas where there's an extra S corp tax. New York City is one of those. If you're a larger organization, there might be more to think about. But if you're the only owner, then it's only going to really affect you the way the firm is structured, right? So the compensation you give yourself simply becomes a business expense, and then the additional income becomes a dividend or a draw, and you're only going to pay federal income tax and state income tax on that portion of your income. So it's not going to be subject to that Social Security and Medicare tax. Next question, can you elaborate on best practices for retirement planning that help reduce tax obligations while securing financial stability for solo practitioners? There's a lot there, right? That's the golden question. Really, my advice to you would really be to try to max out those opportunities you have. Start with, if you're a solo, I love the solo 401k. It really permits you to squirrel away a lot of money, more than the SEP IRA. It really does not cost hardly anything to set up and run. That would be my go-to as far as really having a great place to put money. And it's not going to be subject to income requirements like your traditional IRAs and Roth IRAs. With that, you have your income limitations that you might run into. But with the solo 401k, you've got your pre-tax option, you've got your Roth option. There's a lot you can do with that. Next up, are there any recent changes in tax law yes. Thank you. Here's the big one that we all need to be paying attention to. The current tax cuts. The TCJA, Tax Cuts and Jobs Act, was passed in 2017. It is set by law to expire in 2025, at the end of 2025. Okay? So what that means is if Congress does nothing, all of the rates and all of the brackets will reset to what they were pre-2017, and they will be adjusted for inflation. So the brackets will change. Most likely, most people will be in a higher bracket and will be paying more in taxes. So this year and next year are potentially low tax years for most people. So it's a great opportunity to be thinking about those Roth conversions. Okay, so that's probably the biggest one. Let's go to the next one. What are the most common deductions solo practitioners and small firms often overlook, and how can we maximize these? Just think about everything you use in your business. I think travel is one, a big area. You could easily pair some vacation time with a business conference, and you could get some deductions that way. Think about everything, your phone, your cell phone bill, right? You probably use your cell phone for work. So your cell phone should be a business expense and a business deduction, right? Just think about everything that you use that could potentially be related to business justifiably. One thing that not a lot of law firm owners do is have their car be a business expense. That's another one, right? Your car could be, if you lease your car, lease it through the business, or have your business own the vehicle and depreciate it through the business. Next up, what are the key tax credits available to small law firms, and how can we ensure we're taking full advantage of them? One I think is really key is if you're starting a retirement plan, you get some tax credits. Yeah, so they give you some tax bonuses. I don't have the numbers off the top of my head, but for the first couple of years, you get tax credits for establishing a retirement plan. So that's really, really powerful. And there are so many. I mean, R&D is one of those weird areas, but if you work with a tax consultant that can help you identify some ways you could qualify for that one. There's a lot in there, but I think one of my favorites is just the fact that you get some credits for starting a retirement plan. How can small firms structure compensation to owners or partners to optimize tax outcomes while staying compliant with IRS regulations? So that gets into the weeds, but again, the best way is through your retirement plan, right? Offer a profit share through your retirement plan to employees. It becomes tax deductible to the business, and then participants are putting it in their 401k, and it's tax deferred. Really take advantage of that, I think, is probably the best thing to do there. For solo practitioners, is it best to put leftover money after contributing to a Roth, to a 401k solo, or a SEP IRA? I personally like the 401k the best. It does have some cost to it. Like I said, $300 to $400 a year to run it, but your contribution limits are higher, basically. And you have the ability to do Roth in the 401k. So personally, I like that one better. What is the most tax efficient way to handle expenses related to professional development and continuing legal education? Yeah, claim it as a deduction. Yeah, that's an easy one. Yeah, you make sure you are informing your accountant of that and claiming it as a business expense. And think about the travel that relates to that too, and make sure you're including all of that. How can law firms best manage estimated quarterly tax payments to avoid penalties? Love this question. You need to have someone doing your profit and loss statement, keeping it up to date regularly, and then you need to work with somebody qualified to help you determine what those payments should be each quarter, right? You could just make, your accountant says you need to pay X amount each quarter. Okay, great. Well, actually, it might be more, it might be less. So you need to pay attention each quarter. What's your profit on your income been so far? What should your estimated tax payment be based on that? And really just try to nail that throughout the quarter. Solo practitioners, what strategies are most effective for separating personal and business expenses for tax purposes? I'm smiling because I'll give you my favorite. It's very simple. Make sure that you keep separate bank accounts, separate credit cards. Don't intermingle them. Sure, maybe your Amex gives you more rewards if you put more things on it, but have two. Have an Amex for your personal and an Amex for your business. Otherwise, it's going to be a huge headache trying to sift through them, and you might make mistakes. You might miss things, right? So keep them separate. And last, we're here finally. If my taxes are very low because I get 3 child credits and have very low expenses, what benefit is there to changing to a corporate structure like an S Corp when I'm already shielded from liability? So, you may not need to be an S Corp. That's the truth. It's not the right strategy for everybody. But in a situation like yours, I would say, hey, take advantage of that low tax rate and max out your Roth IRAs and your Roth 401k. And that's it.
Awesome. Well, thank you so much, Darren, for sharing that additional insight. And thank you all so much for submitting those questions. We want to thank you for joining us for another Justia webinar. Additionally, I wanted to remind you all, as I did at the top of our presentation today, of the services available to you through our website platform, Justia Elevate. Justia Elevate is our innovative, feature-packed website solution designed specifically for law firms. It's built on a powerful WordPress platform and offers cutting-edge tools like our Justia AI Writer and our AI-powered Justia Chat to help you both create content and get the leads that you want. Additionally, pricing starts at just $82.50 per month if you pay annually. So if you're interested and you'd like to find out more, you can visit us at elevate.justia.com, or you can always give us a call at 888-587-8421. And have a wonderful rest of your day.
Thanks for watching. We hope you enjoyed this video, and if you did enjoy it, please click the like button and subscribe to our channel for more videos on law practice and legal marketing. See you in our next clip.